Hello everyone, welcome to your own channel Daily Commodity. So today's topic is related to trading of a commodity which is unrefined petroleum that occurs naturally and it mostly composed of hydrocarbon deposits. It's a finite resource that can be refined to produce everyday products like gasoline, diesel fuel and petrochemical for plastics. Before the Industrial Revolution, agriculture staples like corn and wheat ruled the commodity market. But today, the crude oil and its derivatives are the mostly actively traded commodity in the world. In today's video, we are going to discuss about why do people trade in crude oil, what are the pros and cons of trading in crude oil, how to trade in crude oil shares, ETFs, CFDs, futures and options. So let me remind you, if you have not subscribed to our channel yet, please do subscribe to our channel and press the bell icon to get all the notifications and updates from Daily Commodity. So let us begin. Why do people trade in crude oil? People may choose to trade crude oil over the other commodities or assets. This depends on the trader's experience and objectives. Some trader may choose to trade oil for first diversification and the second is speculation. First, diversification. Traders who wants to add a highly volatile commodity to their portfolio may choose a high risk, high reward commodity like crude oil. The second is speculation. There are often wild swings in the commodity prices. Trading in crude oil future and derivatives like CFDs can be a way to profit from volatile oil price. Crude oil prices commonly move from 5% in a single day. Trader must also take a note of that such volatility comes with an equal measure of risk. So now let us know what are the pros and cons of trading in crude oil. Oil is popular commodity on the global scale, but crude oil trading comes with the advantage and the disadvantage. Pros: potential for the high profit margin due to high volatility, especially in the company share with a smaller market capitalization. And the cons are oil is free competition with nuclear and renewable energy resources like ethanol. So now let us know how to trade crude oil in stocks. Shares are the least complex way to trade crude oil where you can purchase equity in an oil company that you believe to become the profitable at a future date. This is usually a correlation between the crude oil price and the oil company's stock price. But this is not always the case. Any disaster has varied as pandemics and oil spill can make the stock price change. So now let us know how to trade crude oil CFD. CFD are nothing but the contract for difference. Contract for difference are the contract between a trader and a broker to exchange the difference in the price between when the trade is entered and exit. Leverage can be fixed or variable based on the margin requirement of the broker for your chosen oil CFD. A crude oil CFD order can be for as little as 25 barrels compared to 100 barrels for the future standard future contract. So now let us know how to trade crude oil futures. A future contract is an agreement to buy or sell the quantity of the oil at a specific date for a specific price. Either the party, the buyer or seller, can draw up the future contract to purchase or sell at the future date. The important things to know about the oil future are margin, physical delivery, and complexity. Margin: most oil future contracts requires about a 10% of the margin, which is relatively high given to the cost of 1000 barrel of oil, although the margin can change depending on the volatility. The second is physical delivery. Future contracts are settled by the physical delivery of the crude oil, which is something most spectacular don't want to deal in. It's very important to keep track of the delivery and expiration date. and either roll the position over another month or close it entirely before the contract expires. Complexity. Trading oil futures are typically for professional traders due to the high cost and complexity involved. However, the contract for difference or CFD provides a way to access the crude oil future markets. So now let us know how to trade crude oil option. With oil option, a trader essentially pays a premium for the right to sell or buy a defined amount of oil at a specific price and specific period of time. Crude oil options are most widely traded energy derivative in the New York Mercantile Exchange, one of the largest derivative product market in the world. Despite their names, the underlying basis of the options is not crude oil itself, but the crude oil future contract. The cost of the option contract is determined by the volatility of the oil price. The greater the chances of the big payout at the time of the contract, the more the option premium costs. So if you like the video, please do like, comment, share, and don't forget to subscribe to our channel. Thank you.